Right now, the only thing dropping faster than Liver King's testosterone levels are U.S. small cap banks. And while a lot of long term dividend investors, such as myself, like to ignore this news, it's important we pay attention and realize how it affects us. So today, I'll be going over how the U.S. small banks crisis affects dividend investors, affects SCHD, and some lessons that we can learn from this time. My apologies if my voice sounds a little like Meet Kevin after getting caught for that DUI. I am sick right now, but help me get some immune support by subscribing, smash that like button while you're at it, and of course, roll the intro.
Hello, I like money.
Investors always talk about the fear and greed index, so let's take a look at it right now. Currently, it's at a 37. Investors are fearing, at least the average investor, which is usually a short to medium term investor. And I mean, there's definitely validity to this. A bunch of banks are crashing and a lot of people are losing money, so of course there's going to be a lot of fear right now. But one of Warren Buffett's most famous quotes is be greedy when others are fearful and fearful when others are greedy. So now might be a solid time to start investing in some dividend stocks that have been affected by this. Right now, the Biden administration and Janet Yellen are under a lot of pressure, which is just a real shame because of how liked they are.
I think I said they're people.
Whoa, who took Grandma's pills away? Right now, Yellen is stumbling and mumbling in Congress, and it's just not a good look right now. So let's take a look at how this affects stocks and our long-term dividend stocks that we know and love. One, obviously the market and stocks overall are going to go down as investor fear is high and people are not confident in the U.S. economy. Regardless of what actually happens and like the actual impact on businesses fundamentals right now with this whole banking crisis, it's what people's overall sentiment on the company, if whether they're buying or selling. If they aren't confident in a company, they're going to sell out of it, regardless of if the business fundamentals are really strong. So obviously, even if this doesn't affect a lot of stocks in your portfolio, your stocks are most likely going to be red right now. Which, if you're an educated investor, it's a pretty good thing if you want to get some really good companies that you like on discount. Let's take a company like UPS, for example. Obviously, I don't think the banking crisis is going to affect UPS too much. They're going to keep growing their business, their free cash flows, revenue, etc. Their stock price is still going to trend down with the overall market, but their business is still getting stronger and they're still paying dividends and rewarding shareholders. So low-key, if you're a dividend investor, unlike me and you actually have capital and cash on hand, you should be excited for this. But right now, since my channel isn't monetized and a lot of you guys haven't liked, subscribed, and shared the video with a close family member or friend, I can't take full advantage of this dip. Next, this affects companies with higher debt. Obviously, companies with higher debt have a lot of money owed to the banks, and if those banks collapse, they're in for a lot of trouble. Let's take a look at a company like AT&T. Over the last 3 months, their stock is down roughly 10%. They're a company that has a lot of debt and uses that debt to fund their operations of their business, which I will talk about more in my 5th point. So right now at AT&T HQ, there definitely is a little bit of fear, I bet. Because right now, your average investor is thinking that all the banks are going to collapse, which obviously very likely won't happen, but it will cause a lot of fear. So obviously, companies with higher debt will likely be trending down right now because of the banking crisis. You'll have to do more research on the stocks with these debt if they can pay it off, their current business outlook, fundamentals, etc. A lot of small cap stocks that also had money in these banks will likely be affected. The next thing that will be affected pretty heavily is index funds. Index funds with heavy financial exposure will be going down a lot. Take a look at famous dividend ETF SCHD right now. They're currently underperforming compared to other ETFs because of their heavy exposure to the financial sector. Roughly 20% of their portfolio is in the financial sector and higher quality bank stocks. And as the stock price of those financial companies and bank sector falls, SCHD will fall as well. Another perfect example of this is Berkshire Hathaway, which usually never trades down but has been trading down recently. They have heavy exposure to the financial sector. Keep in mind, a lot of the holdings in these index funds like Berkshire Hathaway and SCHD are very high quality holdings, and their business fundamentals will most likely not be affected, but their stock price is going down right now because the average investor is fearful of the market and really fearful of just bank stocks in general, so they're just putting their money elsewhere likely right now. As I mentioned earlier though, and as I keep mentioning on throughout the video, if you're a long-term investor, this could be a really good opportunity. Next, of course, this is going to affect the financial sector as people are going to be more fearful regardless of how high quality the business and banks and the financial sector that you're investing in. I personally avoid the financial sector right now because I already get enough diversification from it from SCHD and Berkshire Hathaway, which I own, and I don't completely understand how a lot of bank stocks work in their free cash flows. I just haven't gotten around to researching it, and I get plenty of exposure in my opinion for Berkshire Hathaway and SCHD as I mentioned earlier. My last stock that it's going to affect is companies that use leverage or debt to fund their business operations. Some of these companies that use leverage average are very high quality companies, but still, regardless, they will likely sell off. Now, I want to kind of talk about some of the lessons that I've learned over the last couple weeks with this whole banking crisis. First off, you can never predict the future. If you asked 100 people a year ago whether they thought Silicon Valley Bank would fall in a year, they definitely say no. In investing, you truly cannot predict the future, and you should always have cash on the sidelines in case something like this happens. The next lesson that I've learned really is keep your emotions out of investing. Right now, a lot of people are panic selling at huge losses out of a lot of these companies, even if their business fundamentals are very high. Buy companies that ideally you're never going to want to sell and just let your dividends reinvest and compound your wealth over time. Invest in companies with amazing business fundamentals and operations that you understand easily. Avoid small cap stocks and stocks with negative free cash flow and that aren't turning a good profit. Avoid stocks in sectors that you do not completely understand, as I avoid financials because I don't completely understand it. Don't invest in little Silicon Valley startup companies. Trust over the long term that the U.S. economy will grow. And reinvest your dividends during bull and bear markets so you could really let your wealth compound over time. And that, my friends, is the end of the video. I want to thank you for making it to the end of the video. If you want to meet like-minded investors, bounce ideas off each other, etc., join the free Discord link in the description. There's no stupid course or whatever. Help me reach my goal of 1,000 subscribers by subscribing. Thank you for watching. Don't do DUI, and of course, do dividend stocks, not drugs. Have a great one.